The Bank of Canada just changed the game. For the first time in a long time, the variable rate mortgage product is looking pretty darn good. In fact, in some cases, it might be lower than the fixed. And I want to have a conversation to show you what is going on in the Canadian mortgage landscape right now. And I've brought a mortgage expert, Jesse Merson, back to the channel today. I'm going to introduce him in a second because a lot of Canadians are about to have a pretty big choice. Are they going to go fixed? Are they going to go variable? Whether that is a mortgage renewal or they are buying a brand new property. So Jesse, welcome back to the channel. Thank you for doing this again. I wanted to bring a real expert on to talk about mortgages because I'm the sales guy. I'm the real estate guy. Let's start with that fixed variable conversation because I mean, a lot of Canadians might have some PTSD from the variable rate from what they just went through from, March 2022 until now. It's been that roller coaster ride. What are you seeing with applications? What are people taking right now?
Great question. And Tom, thanks for having me back. Pleasure to be here. It's nice to be called an expert. So I appreciate that. Yeah, I mean, a lot of people have a, sour taste in their mouth from variable rates just because of what happened. They increased very rapidly when we were told they weren't going to. And so a lot of people that had historically been comfortable with the variable rate just have shunned them, not interested. Also, on top of that, variable rates have been priced higher than a fixed rate. And so, it's sort of tough to take a higher rate with the risk that it's not going to come down. It may actually go up. And now that we've had a couple of cuts, you're absolutely right. We're starting to see the end rate on some variable, terms be priced actually a little bit lower than the most common or some of the fixed rates. So the 3 and 4 and 5 year fixed rate terms. And so all of a sudden that, rings some alarm bells with people because of course, everybody, when you're shopping for a mortgage, you're talking to your experts and your team. The lowest rates are obviously going to stick out right away. And now all of a sudden, some of those lowest rates are offered on the variable terms. So, you can probably, right now get easily prime minus 0.6 or 0.7, maybe a little bit more on a high ratio, like CMHC insured mortgage. And so that puts you well under 4%. And fixed rates are sort of about there, if not maybe slightly higher. And so if you are comfortable with the risk that comes with a variable rate and the potential that we could get some more cuts over the next 6, 8, 12 months, a variable term looks quite attractive when you compare it to a fixed rate.
I know a lot of people are thinking like there's a lot of fixed rate people that are like, okay, but maybe for the short term, I take the variable and then lock it into a fixed when I feel like it makes sense. Is that as easy as it sounds? Can you just take the a 3-year variable and halfway through lock it into a fixed? Is there penalties associated with that? Like what do people need to know from jumping around from a variable to a fixed?
Yeah, and that's a great question. And it's almost, if you are going to choose a variable closed term, the flexibility to convert to a fixed term at any time is a nice little insurance policy, right? Because if all of a sudden the rhetoric changes, the economy changes, it's firing on all cylinders, there's talk of rates increasing and you're not comfortable with that, you can convert out of a variable close to a fixed rate term at any time. With all the banks and most of the lenders out there, you can do that without a penalty. There is no breakage fee. Of course, there's a document to sign. Now, the options at conversion, that's where things differ from bank to bank and from lender to lender. Not all banks, not all mortgage providers will give you the same options when converting. And what I mean by that is the new term that you're selecting. One very common rule across many lenders is that the new fixed rate term has to be greater in length than what you have remaining in the variable. So that's an easy one. If you've got 3 years left in your variable term, you have to lock in for at least 3 years, 3, 4, or 5 years in the new term. And again, you can do that without paying a fee. There is no penalty. It's just a simple conversion. So you just want to take a look at what those options are because some banks will allow you to convert to other terms, regardless of how much you have left in the variable. So those are things you want to know about. I tend to recommend to my clients, if you're going if you're going to choose a variable term, you really want to try and stick with it through thick and thin, because here's the reality. By the time you decide that you want to switch out of a variable to a fixed rate, most likely those fixed rates have ticked up a little bit already, right? Because don't forget, fixed rates are somewhat priced or driven by bond yields, and capital markets are forward looking. They anticipate what the Bank of Canada decision is going to be. They anticipate what the economy is going to look like in the next 60 days and be well beyond there. And so if bond yields tick up, you'll see fixed rates go up. And then if you approach your lender and say, well, I'd like to lock in now, you may have missed the boat. And so again, it depends on the economics of the time. But, you know, I would say if there's chatter of maybe one rate increase, that shouldn't make you jump ship out of a variable. And if it does, probably you shouldn't be in a variable anyways. You should have maybe just locked in to have a constant, you know, and not worry about those risks. But historically, variables have outperformed. There's no doubt in that. There've been a number of studies on that, but it just comes down to your comfort level with, you know, having a rate that you're not going to have any control over. But it's certainly become more attractive these days.
Right now in your business, you get lots of applications on your desk from people, whether it's refis or buying new properties. Is there like a percentage you can give us here today? Like right now, end of 2025 timeline, is it 50-50 or 70% of people going variable? Like, what are you seeing?
Yeah, so definitely the start of the year, it was all, you know, 3-year fix was very popular. 5-year fix was very popular. Maybe a few variables sprinkled in there. But if you think back to early in the year, spring, even early summer, we didn't really have a lot of confidence that the rates were going to come down. And the fixed rates were in a pretty decent spot. And so, you know, it was hard for people to sort of say, okay, I'm going to go variable and bank on some rate drops, when we really weren't getting the message that that was going to happen anytime soon. So now, especially up to the last drop just a couple of weeks ago in October there, conversations have certainly picked up around variable. People are looking at it and, you know, sort of saying, okay, rates are back down to a somewhat reasonable level. I mean, historically now, if you look at where rates are, under 4% is pretty good.
Right.
I know everybody still has, you know, 2% maybe below or 2.5% in their mind from years past, but we have to remember, you know, 2020 to 2023, that was not a normal time for mortgage rates. So forget what happened during that time frame and maybe look at the years prior, you know, the 10 or even 20 years prior to, you know, that time frame, and look at where rates were then. And if you look at where they are today, they're actually in a pretty good spot. So I have had a few clients choose the hybrid approach where you lock in a portion, you know, into a fixed rate and put the other portion into a variable rate. It's a diversification approach. So that gives you the best of both worlds. But I would still say right now, I'm probably 2/3 fixed and another third is entertaining variable right now. It all depends on sort of life stage and, you know, what you do for a living, how you're compensated. You know, one interesting thing with variables as well that a lot of people are sort of asking about is, you know, what happens to my payment if the rate changes? Because that was a big thing that came up during the pandemic. It never was really talked about what happens with your payment because rates were very, very stable. And so now there are lenders out there where if you choose a variable rate and the rate comes down, your payment comes down. And vice versa, if rate goes up, your rate goes up as well. But anybody that's sort of feeling that cash flow crunch or is renewing and, you know, wanting to stick to a shorter amortization and not adjust that and reduce the payment, you know, they may choose a variable rate where if the rate comes down, your payment comes down a little bit as well. So again, just part of the planning discussion, right? To take a look at whether or not that makes sense. But yeah, I'd say still there's a fixed rate bias just because things are pretty unknown right now. I would think the variable, if we continue down the path that we've seen the last couple of months, I think variables could pick up steam spring, summer next year.
Just final question on this, and we'll move on to the next topic. But the two types of variable rates, just for anyone that's not aware, is getting a new mortgage. There's an adjustable variable, which your payment changes, goes up or down with the overnight rate from the Bank of Canada, right? And then there's the static payment, which the idea is the payment stays the same, which as rates were going up rapidly, all it was doing is you were just paying more interest, right? And then
Well,
it got
that's
to a
right.
point where you hit the trigger rate. Now, the static payment, if rates drop, is something we haven't dealt with more
Right.
recently. So
Yep.
ideally,
Yep.
same idea, your payment stays the same, but it's actually a good thing when the rates drop because more is going to the principal or the initial loan,
Exactly.
correct?
Yeah, exactly. And there's a lot of people that like that because when the rates went up, less and less of their payment was actually paying off the mortgage. In fact, there was many people where they were just paying the interest, right? And
Yeah.
so for maybe a year and a half, close to 2 years, they weren't really paying down any of the mortgage itself. They were just sort of paying off the interest that was due. And now if you have a variable rate mortgage with a static payment and the rate is coming down, now you're actually able to pay some of that principal down, which is
Mm-hmm.
great. And so a lot of people are sort of playing catch up from the prior couple of years. So yeah, it's definitely a question you should have if you're looking at variable is, what happens with the payment if there's a rate change? And then also what are my conversion options later? Another one that comes up sometimes, and we were chatting about this just before we started recording, was the portability.
Yeah.
You want to check with the variable close, is it portable? Some lenders don't allow you to take your variable close mortgage from one home to another if you sell your current home and buy a new one. It depends how it's structured. It depends on your product. It depends on your lender. And so those are things that you want to get ahead of because nobody waits until the end of their mortgage term to go and buy a new home. You do that when you're ready, when the life changes, when you have that need to do so. So you want to make sure that, you can take that mortgage with you if needed. And if you can't, be prepared to pay that breakage fee.
And if you are looking at the variable rate mortgage and you have these two potential options with whatever happens with the overnight rate, does every lender give you both options? I know in the past it used to be certain banks only did the static payment. Is it lender by lender? How is it working like right now?
Yeah, so it is. Most of the banks have a static payment. Scotiabank has a payment that will adjust based on
Yep.
the rate change. So that's an automatic. They would tell you about it. It would be upfront disclosed and
Sure.
whatnot, but it's an automatic. So when you hear the Bank of Canada has dropped their rate today, the next day or within the next payment cycle at a minimum is when that new interest rate will be factored in. You'll get a letter in the mail saying, here's what your new payment is. The other banks will leave your payment static. And then again, as we discussed, more of your payment is going to the principal portion. So yeah.
Okay. So let's move on to another kind of topic that was making a lot of waves in the news recently, and a lot of people that own maybe several investment properties or that's their path to retirement, whether they want to build a portfolio of real estate. There was a lot of concern that there is potentially these new regulations coming in early 2026 that will change how lenders are looking at rental income, or potentially that you can't double up on rental income. Can you explain like kind of what's happened there to the people watching
Sure.
this?
Yeah. So essentially, OSFI has decided that there's some risk in the rental market, the investor market.
Mm-hmm.
And so they've tried to look at ways to reduce that risk essentially and make it a little bit tougher to accumulate rental properties. I think the thought behind it is there is some concern with individuals that perhaps are overly reliant on the rental income from their properties, because if all of a sudden that rental income is reduced by 20-30%, or even worse, you have vacancies and you're not getting that income stream, how does that impact the repayment of the mortgage, which is what
Right.
lenders are focused on? That's what the regulators are focused on. Regulators, they don't want to see any defaults, they don't want to see foreclosures. But I think that the times were so good for so long that you could just sort of accumulate one, refinance it, get the income, get another one, and now you have some individuals where they have 5, 6, 7, or potentially even more.
Mm-hmm.
And all of a sudden that, becomes potentially a risk, because what happens if a couple of those units end up, losing that cash flow? So I think that's some of the reasoning behind it. I think also, and you probably have the better stats on this than I do, but I think it opens up, if they reduce the amount of properties that can be purchased as investments,
Mm-hmm.
that opens up more housing stock for
Yeah.
other people to potentially get into home ownership. And of course, with this housing shortfall, maybe if they sort of reduce the investor aspect of things, it does open up more doors for people to get into. So that could be some of the reasoning behind it. Essentially, what they've done is they've increased the capital requirements that lenders need to have set aside when they provide a loan. So they've increased it. And so what that could potentially do is it makes it, lenders are going to be a little more strict in the way they review your application. So the double income thing is coming into play, where they say, if you buy an investment property, we will use your employment income to help you qualify for that first investment property, but we will not use it again. It has to, the second, third, and beyond, those properties essentially have to sort of carry themselves. And so that'll be interesting, because I think, and I've been doing a lot of reading about this, there is still some clarification that we need in terms of how that's going to be policed from one lender to another. A lot of my investor clients are already well diversified across the banks. They'll have, their home with one bank, and investment property with another. The reality is too, even before these rule changes were announced, lenders are pretty strict on how they qualify you for a rental property. That's just the reality. Is there's a number of mechanisms that lenders can use to take a very conservative approach to how much they will lend you, or how much they'll approve you for towards a rental property. And so, for example, regardless of what the rents are, they'll deduct a portion for vacancies, additional maintenance. They will, for existing owned rental properties, regardless of what your actual mortgage payment is coming out of your bank account, they'll stress test that mortgage at the stress test rate to create a higher carrying cost, again, to sort of stress test that portfolio, stress test that property. So there's already a number of mechanisms in place that make it somewhat tough. But I think what they're going to be doing here with these rules is really take away the extremes, take away the froth they see as risk. And so from a long-term perspective, I think it's probably a good thing. But yeah, we're all still waiting on some clarification on income double counting and how that's going to play out. But I mean, if you're a first-time home buyer, again, these rules really aren't going to impact you whatsoever, because you're going to be buying a home for yourself. These are more so for people that are buying investment properties and plan to accumulate a few of them over time.
So let's go to our third topic today, which I think is really important, because I've found, at least, and I don't get into the nitty gritty of the mortgage conversations, my clients are connecting with you when that happens, but everyone is so focused on what's the mortgage rate? What's the lowest mortgage rate that I can get? And they don't ask any other questions. So you've got your mortgage rate, which is the first thing. You've got your prepayment privileges, depending on what that looks like. You've got the potential penalty, and then the portability of the mortgage. Like, I feel like those are the four things that are the most important, but everyone's so fixated on the rate. So rate, we don't need to talk about. I think that's self-explanatory. Let's go to number two, and let's talk about prepayment. What are you seeing for prepayment privileges if you want to make that lump sum payment, which can knock off years off your mortgage?
Big time, yeah.
What are you seeing? Is it 10%, 15%? How does it work with fixed versus variable? What do people need to know?
Yeah, so in terms of prepayments, it's super important to know about. So there's usually a few different kinds of prepayments. And so when I say prepayment, that is additional money that you can pay towards the mortgage principal over and above your regular scheduled monthly or biweekly payments that you're making. And so these are important to know, because to your point, these extra payments will reduce the amortization, they'll reduce the interest that you pay over time. They're really helpful tools to help you become mortgage free sooner. They also can accommodate different types of compensation. Some people get a large year-end amount paid to them. Some people are on full commission and a little more sporadic in terms of how they're paid. And so these are tools that you can use. Now, as far as lenders are concerned, with lump sum payments, you're going to see anywhere from 10 to 20% of the original amount that you've borrowed. So this is important to know as well. So if you borrow, say, $500,000 mortgage and you've locked in for 3 years, for that 3-year time frame, if you have a lender that gives you 20% prepayment, that's $100,000 in each of those 3 years that you can make as a one-time lump sum during the year. It's key to know that this is one time as well, right? So it's not like you could do 20,000 one month and then follow up a couple months later with another large lump sum. You kind of would just do that once per year. When that mortgage renews into a new term, let's say that person that went with a 3-year now has renewed into a 5-year fixed. For the next 5 years, that 20% prepayment is based on the mortgage balance that was renewed into that new term.
Not
So
the
on the
initial
original
one.
500.
Right.
Exactly. So that's important to know about. So you've got your lump sum, which is great. That's for very large amounts that may come to you that you want to apply to the mortgage. A lot of lenders also offer the ability to increase your regular scheduled payment whenever you're making those payments again, whether it's monthly or biweekly. That can be a helpful tool if you have a change in income. It's just more common to have smaller amounts more frequently than it perhaps
Yeah.
is to have a larger lump sum that you want to apply to the mortgage. So these double ups or these payment increases are super helpful. Accelerating your repayment is also a great way to save some money on interest, reduce the amortization. So these are all sort of considered prepayments that you can make, and they're important to know because they're not all the same across lenders. And so depending on how you're compensated, depending on, some people will, for example, have an inheritance coming to them, for example, and they want to put that on the mortgage. Well, if that's coming in 8 months, how do we sort of accommodate that when it does come to fruition?
Right.
One lender may not allow you to make that large of a prepayment. So how do we get ahead of that and make sure that you're prepared, to make that payment in the future? So that's something that's important to take a look at. Usually on a lot of the super discounted mortgage offerings, you're losing some of those
Right.
additional benefits and flexibility.
Yeah, I think anyone renewing or getting a new mortgage really needs to ask the mortgage broker or the bank, or obviously just reach out to Jesse and have the conversation, is like, what is the rate? What is my prepayment privileges? What is the potential
Yeah.
penalty if I break? And variable has always remained
Right.
the same, right? It's 3 months interest.
Yeah.
The fixed
Yep.
rate is a different calculation, which is typically more money than the variable. So like if you're renewing on a property you're thinking of selling in the next 2 years, you might want to go variable just for the fact that the penalty is cheaper when you
Yep.
sell it, right? So
Oh, for
those are
sure.
things. But with the fixed rate penalty, I know the math is not easy to
Hmm.
run these numbers, and
Yeah.
every bank maybe does it
Yeah.
slightly differently. But it's I guess just what I want to let the viewers know is it's usually higher than the variable in most cases. Is that fair?
Yeah. Yeah. It tends to be, exactly. And the reason for that is that when you break a fixed rate mortgage, the rule across all the big banks is they charge you the greater of 3 months interest or the interest rate differential, which is that sort of, formula that they look at. So yes, it ends up being, more than a variable rate. So anybody that's in sort of a shorter term time horizon in
Mhm.
terms of maybe looking to sell or looking to move, variable could be a good option for that because it mitigates some of those additional fees down the line. So that's, again, it's part of the conversation, something you want to get ahead of and be aware of. A lot of people will get caught up in the here and now and just want the lowest rate. But that can, sometimes create problems later on down the line.
I know a lot of people that will only take fixed on their house, on like their primary residence,
Mm-hmm.
but then they'll
Mm-hmm.
go variable on investment properties just to allow that if they had to sell it, the penalty wouldn't be as bad.
Sure. Yeah. Yeah.
Everyone's got their own different
It's
situations. And then the last one
for
I wanted
sure.
to bring up, Jesse, was just the portability.
Hmm.
Other than everyone losing their minds because Trump wanted to do a 50-year amortization, and now they're talking about allowing Americans to port their mortgages, which I'm sure most Canadians thought, oh, they could always do that. No, they can't. That's
No.
one of
Yeah.
the issues,
Yeah.
right? Why they had inventory
Yep.
issues a few years ago is because you had a 2% rate for 30 years. Why
Right.
would you ever sell
Nobody
that
was
place
moving.
to go to a 6%? Now they're talking about
Right.
porting the mortgages. But here in Canada, our penalties are definitely way higher than the States. I don't even think states really have big mortgage penalties. But, I sell my property and I want to upsize to another one. I'm bringing my mortgage with me. Maybe I'm borrowing a little bit more to add on top to it, blending and extending it. Are
Yep.
most mortgages in Canada portable?
Most are, yes. Most are. Now, where it can change is sometimes some lenders don't. Again, some of those really deep discount lenders, that's one option or one benefit that you may not
Hmm.
get. But as far as the big banks are concerned, most of the terms are portable. Now, there are some rules to qualify for porting. The closing dates, so the
Hmm.
sale date of your new home and the close date of the new home, have to be within a certain time frame. So usually 90 or 120 days. If you're outside of that, then you've got to pay a penalty or a breakage fee. Typically, you're not going to be able to port if you've got 6 months between the closing dates.
Portability of mortgages, just because again, people watching this are at different levels of education on everything going on. That is you still have your mortgage, you're just moving it to a different property. And I think a lot of people, not that it really matters because all those 2% rates are coming up now, but assumability of mortgages hasn't really been a thing. Is it technically allowed? It just doesn't happen. Like, are you seeing any of that?
It's allowed for sure, and it's available, but I can't recall in 20 years having ever seen an assumption done, maybe once or twice. But usually, if it's a good rate, most people are selling their home and buying a new one, so they want to keep that rate for themselves,
right?
So I'm sure it happens, and it's a nice feature to have out there. It could, depending on the environment, be a selling feature. If you're selling a home and it's got a really great rate, and it's perhaps an investment property, and somebody's buying that investment property for their own primary, and it comes with a 2% rate in an environment today where rates are 4%, that would be great. That new person has to be able to qualify at, whichever lender has that mortgage. So assumability, we don't see a lot of. Portability is super common. And again, it's good to know how that works if that were to come up, because again, not all variable closed conventional mortgages are portable if you're blending and extending or need to borrow more funds. So that's something to know. A lot of these hybrid type collateral charge products, like the ones that build in a secured line of credit, those typically are all portable. And if you've got an existing mortgage segment for any new money you're borrowing, that would just be a brand new segment at whatever rates are at that point in time created within the plan. So again, these are all things you want to get ahead of and understand what that looks like, how to line up maturity dates in those multiple segments, for example. So there's a lot of things to consider when you are porting. But yeah, portability is a great feature. It doesn't cost anything. Lenders do not charge you to port. It's usually just baked into the disclosure terms that it's an option. And yeah, you just have to go through that application process with the lender if that's something you're looking to do.
I think we'll wrap it up there. I appreciate the conversation today. Really, you were just answering all my questions, but I'm more of an interview. Yeah. But I think this was great. If someone's made it to the end of this video, I've worked with Jesse for well over a decade. He's my personal mortgage broker. I will put Jesse's information below. If you are someone looking to get a new mortgage or refinancing, I guess no one's really refinancing, but renewing, then definitely reach out to Jesse. I'll put his information below. And Jesse, any final thoughts about anything going on in the mortgage world that people need to know about?
I mean, I think right now the best thing to do is just plan properly, because we are in a volatile sort of time, and it's important to know all of your options before you make that final decision. So engage your real estate professional, engage your mortgage professional, have that team put together a plan for you, and that will set you up on the correct path.
Awesome.
Thanks for having me, Tom.
Absolutely. Thanks for being here. Thank you everybody for watching and listening, and we'll talk to you soon. Bye.